Welcome to Griffonomics.
Glad to be here for this one.
So, okay, let's just unpack this right from the start. Imagine having a product that is so universally beloved, right? It practically prints billions of dollars on demand. Customers are just begging to buy it.
A literal cash cow.
Exactly.
Yeah.
It is a certified cultural icon. And your grand strategy, you deliberately stop selling it to them.
Right, you just choke off the supply completely.
You choke off the supply of your own biggest revenue driver. And today is Friday, April 3, 2026, and our mission for this deep dive is to explore exactly why a massive, $46 billion global behemoth like Nike, Inc. is doing exactly that.
It sounds crazy on paper.
It really does. We're tearing into this highly granular strategic report and an investment roadmap today to answer one core question for you. Nike is engineering a fundamental shift away from lifestyle streetwear, right?
Okay.
And they are forcing this brutal return to pure athletic performance.
Which is a huge pivot.
It is one of the most aggressive corporate turnarounds in modern history, frankly. But is this painful surgery actually going to save the patient?
That is the multi-billion-dollar question right there. Because when you look at the sheer scale of Nike, you realize they are trying to rewire their entire corporate DNA while the car is still, bombing down the highway at 80 miles an hour.
Yeah, they can't exactly pull over to do this.
Exactly. We are looking at a really deep stack of fresh sources today. We've got everything from their Q3 2026 financial transcripts to competitive moat analyses.
Some really dense stuff.
Very dense. And we're going to look under the hood at the mechanics of this evolving business model, unpack the severe global hurdles they are currently slamming into, and map out their timeline for survival. So by the end of this conversation, you should have a crystal clear picture of what this transformation actually means for you as an observer of global markets.
So to really grasp where Nike is heading, we first need to appreciate the staggering size of the engine they are trying to rebuild. Just looking at the third quarter numbers, the scale is wild.
It's massive.
The Nike brand itself drives 97% of the company's total sales. That leaves Converse sitting at just 3%.
Barely a blip, relatively speaking.
Right. And within that massive 97%, it is overwhelmingly weighted toward footwear. We are looking at roughly $7.6 billion in footwear revenue compared to about $3.2 billion in apparel.
Right. So they are fundamentally a shoe company first and foremost. But for the last few years, the fuel for that massive footwear engine wasn't high-tech running shoes. It was driven heavily by what the industry calls lifestyle or classic sneakers.
Like the shoes you wear to the coffee shop.
Exactly, not the track, things for walking around.
Yeah.
But the strategic inflection point we are examining today is what Nike's management is calling their sport offense.
The sport offense.
Right. Yeah. So CEO Elliott Hill recently stepped in, and he didn't just casually shuffle the org chart around. He took 8,000 employees and fundamentally restructured them.
8,000 people?
8,000 people, yeah. He moved them into sport-specific divisions. So running, basketball, global football. The entire operating philosophy is this hard, deliberate pivot away from casual lifestyle wear and a desperate return to their roots in elite athletic performance.
And here is where we hit that paradox I mentioned at the top. Because part of this sport offense pivot involves what management aggressively labels their win-now actions.
Go now.
Yeah, but looking at the mechanics of it, honestly, it looks a lot more like self-sabotage. Nike is intentionally restricting the supply of its massive, legendary classic franchises. They're actively pulling the Air Force One, the Dunk, and the Air Jordan 1 off the shelves.
Which are their biggest sellers.
Right. And this intentional cleanup actually created a massive 5-point headwind to their Q3 reported revenue. Financially speaking, starving your own most profitable product seems completely insane. It's like a hit TV show killing off its most popular characters just to force the writers to come up with new ideas.
That is a great analogy. It absolutely sounds counterintuitive. Why refuse to sell the shoes that everyone actually wants to buy?
Right. Why?
But if we look at the underlying mechanics of brand equity, it makes cold, calculated sense. Here is exactly why they had to do this. Nike's brand premium was rotting from the inside out. Over the last few years, they flooded the global market with these classic franchises.
They're everywhere.
Everywhere. And what happens when supply completely outstrips demand? The market becomes incredibly promotional. Your premium status symbol lifestyle shoes end up sitting on discount racks at outlet malls.
Right.
And the moment that happens, you lose your pricing power and you lose your prestige.
So by deliberately choking off the supply, they're artificially forcing scarcity back into the marketplace.
Precisely. They are retraining the consumer. And the data from the report shows that it is actually working. The full price realization.
Full price realization, what does that mean exactly?
Oh, that just means the percentage of shoes sold at retail price without any discount. So that metric for the Air Force One and the Air Jordan 1 is finally stabilizing. So yes, taking a 5-point revenue hit looks absolutely terrible on a quarterly earnings report, but it is necessary, painful surgery to save the long-term health of the brand.
Okay, I follow the logic of preserving the brand halo, for sure. But this brings up a massive physical problem. If you pull roughly $4 billion worth of classic shoes off the shelves by the end of the year, you leave a colossal vacuum.
You do?
And nature abhors a vacuum, and Wall Street definitely hates an empty shelf. You can't just cut supply, right?
Oh.
You desperately need new, innovative products to fill that multi-billion-dollar void.
Which brings us to Nike's innovation pipeline.
Exactly. And looking at the sources, they are betting heavily on a totally new footwear platform called Nike Mind.
They are betting the farm on it. What is fascinating about Nike Mind isn't just the design, it's the highly specific mechanical focus. The platform is built around what they call pre- and post-competition focus.
Which sounds very technical.
It is. It's backed by 150 global patents. It completely sold out globally on its initial launch, and management is currently scrambling to double production just to meet the demand of a 2 million person waitlist.
Let me jump in on that, because post-competition focus sounds like absolute marketing jargon. I actually dug into the mechanics of what this means. After an elite athlete finishes a marathon or a basketball game, their feet physically swell.
Right, the arches drop.
The arches are fatigued. So these 150 patents aren't just for a cool logo. They are for dynamic decompression mechanics, like variable foam densities that actually expand as the foot swells. It actively aids in blood flow and physical recovery while the athlete is just walking around after the game.
Wow.
It is a highly technical piece of equipment that is just disguised as a shoe.
Exactly. It's not a fashion statement, it's a recovery tool. And that proves they still have the engineering chops. And we are seeing this performance pivot pay off structurally in other categories, too.
Oh, like...
Yeah, the running division was the first to fully adopt this new sport offense structure, and their revenues surged over 20% in the quarter. Plus, they aren't just staying in their traditional lane of team sports. They are expanding horizontally into totally new use cases.
Right. The reports note they are rebranding ACG, which is all conditions gear, to make a serious play in outdoor performance and hiking.
A huge market.
Yeah, and they're making a massive play to disrupt the activewear market through a partnership with Kim Kardashian's shapewear label to launch Mikey Skims. That is clearly aimed at capturing the demographic that Lululemon currently dominates.
That horizontal expansion is really crucial. It diversifies their revenue away from just the basketball court or the soccer pitch and integrates the brand into the daily wellness routines of entirely new demographics.
I hear that, but I have to push back on the math here. 2 million people on a wait list is an incredible headline. And Nike Skims sounds like a marketing dream. But scaling those highly technical shoes and new activewear lines quickly enough to seamlessly plug a $4 billion revenue hole left by the Air Force One?
It's a huge gap.
It feels like an incredibly tight, highly dangerous high-wire act.
It is the ultimate test of their operational capacity, and it highlights the exact execution risk that analysts are just sweating over right now. The innovation proves the capability is intact. But scaling it is a completely different beast, especially because they are simultaneously ripping up the literal plumbing of how they sell these shoes.
Yes, the pivot from direct-to-consumer back to wholesale. Let me put it this way for you listening. For years, Nike ran a direct-consumer-first model. Think of that like watering your garden with your own private hose.
Okay, I like this.
You control the water pressure, you own the hose, you keep all the profit. But it limits how much ground you can cover. Now they are pivoting back to relying heavily on wholesale partners like DLK Sporting Goods and Foot Locker. That is like plugging directly into the city's main water line.
Much more volume.
Exactly. You can flood the entire neighborhood with product instantly, but you have to share the profits with the city, and you lose total control over exactly how the water is distributed.
That is a perfect way to visualize it. Integrating these massive new product lines across a sprawling global wholesale network takes time, negotiations, and just logistical harmony. It is not an overnight fix.
So what does this all look like when the dust settles on the ledger? The innovation pipeline sounds promising in theory, but the actual Q3 balance sheet reveals the severe financial friction of ripping up your own plumbing. Let's look at the hard numbers. Q3 revenues came in at $11.3 billion.
Which is huge.
Huge, but on a reported basis, that was completely flat, And the reports emphasized looking at it on a currency-neutral basis, which strips out all the chaos of global exchange rates to show us how much actual product moved.
Right, the real underlying volume.
Exactly. On a currency-neutral basis, revenue is actually down 3%, and earnings per share came in at only 35 cents.
And if we dig into the margin forensics, that is where the pain becomes highly visible. Their gross margin dropped 130 basis points, landing at 40.2%. Let's translate what a basis point is for a second. 100 basis points equals 1%, so their gross margin dropped by 1.3%.
Which doesn't sound like a lot to a normal person.
No, but when you are dealing with $11.3 billion in quarterly revenue, a 1.3% drop means hundreds of millions of dollars of profit simply evaporating into thin air.
And we need to be very clear about the mechanics of what caused that evaporation. It wasn't just them discounting old shoes. The reports point to a massive structural $1.5 billion annualized cost headwind from new U.S. tariffs.
That's a huge external hit.
It is. To be clear on how this works mechanically, when Nike manufactures a shoe overseas and brings it into the U.S., the government slaps an import tax on it. Nike can either raise the price of the shoe for the consumer or eat the cost themselves. Right now, they are eating a massive portion of it, and it is just bleeding their margins dry.
It is a staggering external cost to absorb while you are already trying to self-fund a massive corporate turnaround. It forces them to play an incredibly defensive game with their capital. Their massive $18 billion stock buyback program remains completely paused so they can conserve their cash reserves.
It's sitting on it.
Right, though they did still pay out roughly $609 million in dividends to keep shareholders from completely revolting.
The line item that really caught my eye, though, was a $230 million pre-tax severance charge.
Yeah, they're restructuring.
The corporate documents describe this as an effort to restructure supply chain and tech divisions, moving from fixed pandemic-era costs to a variable model. Let me translate that corporate jargon. What they actually mean is they are laying off a massive amount of people and taking heavy financial penalties to shut down or untangle these massive distribution warehouses they built during the pandemic digital shopping boom.
Your translation is spot on. During the pandemic, the entire industry hallucinated that direct-to-consumer digital shopping would just grow to the sky forever.
Everyone thought we'd never go to a store again.
Exactly. And Nike built a heavy, highly expensive fixed-cost infrastructure to support that illusion. Now that they're plugging back into the wholesale water main, like you said, with partners like Foot Locker, that massive digital infrastructure is a massive financial albatross.
It's just weighing them down.
Right, so they are taking the pain of severances and lease breakages right now. But it is worth noting that Nike still has a fortress balance sheet. They are sitting on $8.1 billion in cash and equivalents. So they are aggressively spending money to shrink their operational footprint today so they can actually grow profitably tomorrow.
But this immense financial pressure isn't distributed evenly across the globe.
Yeah.
When you look at the geographic map in these reports, Nike is experiencing a stark two-speed reality.
And it's really a tale of two entirely different consumer markets right now.
Yeah.
Let's look at North America first, which is serving as the lead engine. The pivot to wholesale that we just talked about, it is actually working here. Wholesale revenues grew a very robust 11%, which managed to drag the entire region to a 3% overall currency-neutral revenue increase. The fundamental demand for the product is absolutely there.
But returning to those U.S. tariffs we just broke down, they caused a brutal 350 basis point drag on North American margins alone.
Right, 3.5%.
Meaning, Nike is successfully selling a lot more shoes to DIC Case and Foot Locker, but they are making significantly less money on every single pair because of those import taxes. To fight that, the reports show Nike is frantically trying to rewire its global supply chain. They are racing to reduce their Chinese footwear imports into the U.S. down to single digits by May of 2026.
They are essentially trying to outrun the tariff impact by physically moving where the shoes are actually made. But then we look at the other side of the globe, Greater China. This is the massive drag on the entire enterprise. Revenues fell 10% in Q3, and management is openly guiding for a staggering 20% revenue plunge in Q4.
A 20% drop for Nike in one of the largest consumer markets on Earth is a total bloodbath.
That's brutal.
And looking at the notes, it's entirely self-inflicted. Management is actively starving the Greater China region of wholesale sell-in. The digital marketplace in China has become incredibly promotional. The Chinese consumer has essentially been trained to sit on their hands and wait for massive digital shopping holidays to buy shoes at steep discounts.
Exactly. It's that brand premium erosion we talked about with the Air Force One, but applied to an entire continent. Nike knows that if they keep pumping fresh inventory into that hyper-discounted environment, they will permanently destroy their brand equity in Asia. Greater China historically used to be Nike's most profitable region globally. The fact that their EBIT recently collapsed 49% there shows how dire it is.
And for those listening, EBIT stands for earnings before interest and taxes. It is essentially the pure core profitability of the business before the accountants do their magic. When the core profitability of your best region gets cut in half, it forces your hand.
You have no choice.
Right. Management absolutely has to hit the reset button, clear out the discounted inventory, and retrain the Chinese consumer, even if it decimates short-term earnings. Like driving a car with your right foot, slamming the gas in North America, while your left foot is just stomping the brakes in China.
Which brings us to the inevitable reaction from Wall Street. Because when you combine these massive geographic anchors, the crushing tariff wars, and the painful supply chain shifts, the market is growing incredibly impatient. We are seeing intense market skepticism and some very real headline risks.
Oh, definitely.
For one, the actual timeline for this turnaround has been officially pushed back. The chief financial officer guided that gross margins will not actually inflect positively until the second quarter of fiscal 2027. And as we noted, Q4 overall revenues are expected to drop another 2 to 4%.
And we can't ignore the Converse brand, which is in a state of absolute freefall. I mean, Converse revenues plunged an astonishing 37% across all territories in the quarter.
37%.
This is a total crisis for that subsidiary. But beyond the spreadsheets, there is also significant regulatory and legal headline risk, adding massive pressure to the stock.
Right. The regulatory environment is adding a whole other layer of friction.
So, according to the source documents we are reviewing, the U.S. Equal Employment Opportunity Commission, the EEOC, has launched a formal civil rights enforcement action. They are investigating Nike for alleged racial and sex discrimination against white employees related to its diversity, equity, and inclusion policies. Now, I want to pause here and be incredibly clear with you listening.
Important point.
Yes, we are strictly reporting the facts of this legal risk exactly as they are detailed in the investment and strategic reports. We are not endorsing any political viewpoint, left or right, or taking any sides whatsoever. We are simply relaying the existence of this federal investigation because it represents a highly material headline risk and a potential legal liability for the company during an already fragile turnaround.
It is an objective, highly visible factor in the broader landscape of market skepticism that institutional investors have to price into their models.
Exactly. So put yourself in the shoes of an investor holding this stock right now. You are being asked to hold on through a 37% collapse in Converse sales, massive global tariff wars eating your margins, and now federal civil rights investigations. And your reward for holding on. A financial payoff that management casually admits is now pushed back almost a full year to late 2026 or 2027. That requires a monumental amount of faith.
It requires an iron stomach. And your skepticism is entirely validated when you look at the broader macroeconomic environment. We do not operate in a vacuum. The sources specifically cite rising global oil prices and severe traffic disruptions in the Middle East heavily impacting maritime supply chains.
Which affects everything they ship.
Everything. When you are dealing with global logistics, volatile input costs, and shifting consumer behavior, 9 months is an absolute eternity in the retail sector. A lot of external things can go wrong between now and Q2 of 2027.
All right, let's bring all these threads together for the final verdict. We've got the undeniable innovation wins, like the running division surging 20%, and the highly technical Nike Mind platform selling out with a 2 million person waitlist.
Real bright spots.
Yes, but we also have severe financial friction, the deliberate China reset, the Converse collapse, and those heavy tariff burdens. Combining all of this, what is the ultimate conclusion on Nike's strategy from the analyst reports? Is this a moment to buy the dip, or is it a value trap?
The aggregated strategic outlook from the reports rates Nike right now as neutral or transitional. The core issue holding it back is the valuation. The stock is currently trading at a premium multiple of roughly 31 times forward earnings.
Let's translate that multiple. What that means in plain English is that investors are paying $31 today for every single dollar of profit they hope Nike makes next year. That is an incredibly high price tag, especially when you consider that Nike's actual operating margins are sitting at an anemic 8%. To put that in perspective, competitors like Lululemon are operating at margins well over 22%.
Exactly. It is the textbook definition of a show-me story. The premium valuation means the stock is highly vulnerable to even the slightest misstep. The market is demanding absolutely flawless execution of this margin inflection by FY 2027 to justify that 31x multiple.
It's priced for perfection.
It is. Now, Nike does possess incredible downside protection. You simply cannot easily replicate their sheer physical scale. They boast 40,000 points of distribution globally. Plus, they offer a solid 3% dividend yield, which essentially pays investors a small fee to wait out the turbulence. The overarching strategy, cutting the lifestyle bloat, returning to high-performance engineering, cleaning up the discounted inventory, it makes perfect logical sense on paper. But management has to actually prove they can execute it in the real world without the wheels coming off.
And that leads me to a final thought I want to leave you with today. Something to really chew on as you watch this massive corporate drama play out. We've spent this entire time talking about the shoes themselves, the mechanics, the margins, the supply chains. But Nike just signed massive 10 to 12-year contract extensions with the NFL, the NBA, the WNBA, and the Brazil national team.
Massive deals.
They are betting billions on the upcoming 2026 World Cup to elevate their global football line. But think about this. If the actual product, the decompression tech, the fit, the style, if it doesn't fundamentally resonate with everyday consumers walking into a DICK sporting goods, are these billion-dollar sports contracts actually the ultimate competitive moat? Or are they just incredibly expensive billboards masking an underlying brand fatigue? It's something to watch very closely as we head into a major year of global sports, risk-defined, portfolio protected.